Good morning, ladies and gentlemen, and welcome to the Equals Group PLC Interim Results Investor Presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated on the right-hand corner of your screen. Simply type in your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. These will be available via your Investor Meet Company dashboard, and we'll notify you by email when these are ready for your review. I'd also like to remind you that today's presentation is being recorded. Before we begin, I'd like to submit the following poll. And now I'd like to hand you over to Ian Stratford-Taylor, CEO, and Richard Cooper. Good morning to you both.
Good morning.
Good morning.
Thank you, Alessandro. Welcome, everybody. Thanks for taking the time to listen to what we've got to say. So without further ado, we'll crack on. If you could turn the slide, please. So the theme of today's presentation, and I can assure you this wasn't deliberate in terms of our performance, but there's very much a tale of two stories here. In the H1 was very good, strong growth. I think I've said in the past that the growth heartbeat of the business is 20 to 25% growth. The second part of the story is really how we're performing in Q3, so from June 30 up to the present day, and you'll see a marked difference, and that's because we unveiled a lot of functionality and new capabilities towards the end of H1. But as I say, H1 was very good regardless. I think the numbers you'll all have seen in the RNS, but some key ones there: revenue up 23% year on year, EBITDA up 138%, and cash. This is a key part of the story for the first half, that we are now operationally cash generative. Actually, we were towards the end of last year, but more strongly now. And that enables us to have a different outlook in terms of, we can invest for growth. 2020, when the pandemic hit, was very much to start with, survival and conserve cash. Now, where we see decent returns, we can push harder. And I think that's important. Now, what led that? It was the operational growth was B2B, as you might expect, very much been our focus of the last couple of years. The investment and significant investments, particularly in 2019, that we made in platforms, connectivity, are paying off significantly now, with more to come. The cost cutting we did in 2020 and in the first half, I make the point several times in the deck, it's cost cutting, but not at the expense of growth. This is very much an exciting period for the company where we need to be pushing forwards on growth as fast as we can. The workforce radically reshaped, leaner, fitter, younger, more energetic. There's a lot of dynamism across the group. It's tangible. People are excited to be working here and excited where the business is going. And regulatory expertise and investment, we view this as a very important area for the company. The fact of the matter is, especially since Wirecard's demise a year and a bit ago, the FCA are very, very hot on all things payments, and the whole industry is being audited regularly, particularly in terms of safeguarding client money is a real hot topic. And our experience is, the more you invest in that area, if you view it as an overhead, it's an overhead. We don't view it that way. We view it as, if you excel in it, then be it the regulator, be it the liquidity providing banks that you operate with, they can see how good you are at it, and allow you to do business that maybe they wouldn't allow other people to do with lesser controls. If we could turn the slide, please. In terms of some highlights for 2021, a tiny bit more detail. As I say, B2B focus. Revenues were robust in H1, but accelerating in H2, as you'll see in a bit. And underpinning quite a lot of what's going on here, and in fact, a key element of what we're doing is this whole concept of a own name multi-currency IBAN. I appreciate that's a mouthful and a bit technical, But in very, very simple terms, most foreign exchange companies and actually a lot of payment institutions, when you pay money to them, it goes into what's called a pooled account, or not an account in your name. We have the capability to give an own name account to all our customers now, be they corporates or in fact individuals. And better than that, just one account or one IBAN, international bank account number, which is the global identifier for an account. Here we're used to sort code and account number. Actually, that's embedded into an IBAN if you look at the top of your statement. That IBAN here actually is a multi-currency account. So you can literally throw any currency at it, it will deal with it. So you only need to remember one number. And for a business, that's very important in terms of dealing with suppliers, customers, whomever. And also for compliance, if you think about it, say you hold money at some other company or it's been collected on your behalf in an account in your name, you can pay it into an account in your name. Here it's called first party to first party transaction, which is a lot easier to deal with. So that product, or sorry, capability, I should say, underpins the Equals Money platform, which is the unified suite of our three underlying core products, be it international payments, card-based solutions, and the banking platform. Equals Money brings those together for SMEs. And on top of that, we have what we call Equals Solutions, which is essentially doing the same thing, but bigger to larger corporates. And you'll hear more about that as we go through the deck. Also on the board and governance, we further upgraded the board in the first half. We added Chris Bones, who has a great background in marketing, particularly digital marketing, B2B as well as B2C, and also has a background in people/human resources, and he's heading up our remuneration committee, so he's a great hire. And also on ESG, very much embraced here, including equality, diversity, and inclusivity on the people side of things. Costs, as I mentioned, strong cost culture. I think that's the right word, but we're not going to cut into bone and inhibit our ability to grow. Sales and marketing, we rolled out HubSpot at the beginning of the year, which is a new CRM system. Any of you dealt with CRM know that you don't just turn on the system and it all works fine and everyone knows how to use it. There's constant training, cleansing of data. To get the best out of that is a moving feast, but we're doing it. We've also invested more into data in general. Cash, we're well capitalized. We've got a decent amount of cash, and we're generating it now. Rich will take you through the details of cash as we get further through the deck. And compliance, as I mentioned earlier, we've made more investment into our compliance capabilities, and we can now onboard automatically what I'd call vanilla, be it B2C or B2B clients, and so we can direct our internal resources towards the more complex or enhanced due diligence type clients as we go forwards. Next slide, please. So Equal Solutions, I apologize for the complexity of this. In fact, there's a slide in a couple that's even more complex. But I think for those of you, that are listening, the complexity is part of the defendability of this capability. I.e., it's not easy to do what we're doing. It's taken 2+ years to assemble. You can make an argument that no one part of it is that complex. Some bits of it actually are, but putting it all together in one platform is complex. And that's another thing we need to remember here, that what we have, we still have our three core main products, as I mentioned earlier: international payments, card solutions, and banking, both B2B and B2C. And what Equal Solutions is bringing those all together in one overall platform, underpinned by the own name multi-currency IBAN. So what you've got there in that first bullet is FX and payment capabilities. And that long-winded bit at the end, essentially a lot of clients that want to use this platform have bespoke, and they are bespoke to each client, authorization protocols, i.e. they might need, person A and person B before they'll release a payment. It could be 4 layers of authorization before they'll release payments. And all of that can be built for them easily into the platform so that they've got complete control as they want it before payments are made out. All of this is underpinned through a series of tier one banks that we deal with. We have 4 tier one banks that we currently deal with, and are looking always to add more. And so we can do payments both in the UK and internationally. And this is all connected via SWIFT to international payment networks. Another key feature within solutions is, a no-name multi-currency IBAN could actually support multi-entity or multi-accounts beneath it. So it could be they have one account, but maybe 100 subdivisions of that account. We can cope with all of that through the solutions platform. And they can get access to all of this via one login rather than, if you think about it, multiple logins or multiple login tokens at banks. Banks generally don't give out multi-currency IBANs anyway, so you'd have literally one account per currency, and it gets very confusing. All of that's augmented internally with a dedicated account and onboarding team that can onboard complex and high-risk accounts way quicker than the competition. And by the way, the competition here is really the banks themselves. As we've preached for many years, but in particular here, we're taking business away from the banks. I've heard from a couple of customers that it could take them 2 or 3 months to open an account, which we can do in 2 or 3 days. And you get some idea of the difference. The other aspects of this that I love, I've always liked businesses where, when no one's in the office, although increasingly post-COVID, it's not as frequent as it was, but you're still making money over the weekend when the lights are out. And on this equal solutions piece, not only do we make money via FX, but we also earn quite considerable amounts via transaction fees. So you're getting towards a more annuity-based revenue stream for the company, which ultimately is higher quality. In terms of scale, 0.3 million of revenues in the first half. Actually, that was 0.3 million of revenues in June, which is when we turned the capability on. 1.2 million in the quarter to date up to the 10th of September. And you get some idea of the direction of travel. Just a little segue there, the fact that we could know to such a level of detail, which you'll see later in the deck as well, what our revenues were line by line in such a lot of detail on the Monday, what they were on the Friday is some indication of the advances that have been made in the finance function here under Richard's able leadership. If we could turn the slide, please. Just some softer things in terms of other achievements in H1. The pay platform, what is that? Pay platform is basically the customer-facing international payments platform. We were, historically, we would give the same level of service in terms of a dealer speaking to a customer, for a customer that might pay us £100 a year in terms of the revenue we could earn, compared with someone that would pay us £100,000 a year. And clearly that's not sustainable and not good business. So the smaller customers, where possible, you'd like to push towards self-serve. For lower volumes, it's more appropriate to align the level of service with the level of revenue we could generate. And to do that, you need, obviously, to have a very good online platform for customers to use. That is the pay platform. It's fantastic, and it's getting rave reviews and good adoption. Concurrently, because it's the same system, we implemented what we call internally the exchange platform, which is what the dealers use. So they're seeing exactly the same view that the customer sees, but obviously with more bells, whistles, and functionality. Even a customer that doesn't deal online at all and only speaks to a dealer will still be registered into the pay platform because all their beneficiaries are there. They can amend their beneficiaries, etc., rather than confirming a beneficiary over the phone and doing via email, which is a compliance nightmare. So very proud of that platform. We have more to come from it. Data, we've built out our data science team more. We're getting far better data out of that team. You'll see later that I emphasize that we're data informed. not data led. What does that mean? It means we don't just take the numbers from data team and blindly follow them. You overlay them with what you know about the business from other sources and make decisions accordingly. CRM, I mentioned earlier, the HubSpot platform. It's a great platform. We're continuing pushing the adoption and optimization of it. We have a team internally called the Sales Enablement Team, whose sole role is to do precisely that. It's a team of 3 people pushing that forwards. Onboarding, we can now onboard vanilla B2B and B2C customers automatically using a system called True Narrative. And on reconciliations, we've got more reconciliations being done automatically. Both of those are little examples of where there's a platform that exists from a good provider that will automate something. Fine, we could build it ourselves, but it's not our core differentiator or core value chain addition. Then let's use the other platform. And then in both those suppliers, we've got excellent solutions there that have helped us leap forwards. We also deployed link cards in the first half, which is an augmentation to the B2C FairFX card product. The important piece there is that we did that using functionality we'd built for the business expenses platform and just dropped it into the B2C arena. On compliance, we had, in common with everyone in the industry, safeguarding audits, which are complete and are all good. And we have, actually, I call it a new head of compliance. We have a head of compliance that we hired in, who is fantastic. And so that talks to the investment in compliance in general. Next slide, please. This is the slide that, funny enough, I had a call with our chairman earlier. I was telling him that I mention him every time I put this slide up. He said that this slide was too complicated, and he's right, but I want people to understand how complicated this is. So how do we support the own name IBAN and all this clever stuff we're doing? We have a concept internally, or a system basically, which is called boxes. And we call it a box because we wanted to define a receptacle you could put something of value into. It's not an account, it's not a wallet, so a box is something you put stuff in. So there you go. That's really, it's no more scientific than that. And it's an internal name for a container that will hold a single currency, or actually a single cryptocurrency if we choose to do so. So each own name multi-currency IBAN has 1 box per currency. In fact, it could have 100 boxes per currency, if that's what the client ultimately wants and wants to subdivide the account that way. But it has a minimum of 1 box per currency. And boxes is our internal name for the service which auto creates a box. So let's give an example. We've got a customer doing dollars and euros with us, who suddenly gets some Hungarian forints in. The system will auto create a box to receive that money. It will auto appear on the platform for the customer, who can either keep it, change it, send it, do whatever they need to do it. So this supports everything that happens in terms of multi-currency IBANs, the whole interface to SWIFT, BACS, faster payments, and SEPA, all via boxes. The focus to start with, in terms of full automation, was on the inbound side, so money into an account or the own name IBAN, and the auto allocation thereof. That, when I say currently being rolled out, it's rolled out in terms of new customers are on it, and we'll move existing customers across as it suits us. So the functionality is live. Outbound is less controversial, and so that was the second thing to do. Not controversial, probably the wrong word, but less. There's more risk when you're taking money in. The customers generally know what it is they want to pay, and of course, paying money out is the lesser priority. That will be live definitely in first quarter next year. It could even be towards the end of this year, but I didn't want to come up with a deadline and then miss it. This is all very clever and great, and straight through processing literally means that more and more transactions have no touch. Hand in hand with that is, you need to be doing more transaction monitoring. Under an inefficient system where you've got people with eyes on each transaction, at least you have people with eyes on each transaction. So it could be they could spot problems, or patterns, etc. So hand in hand with more automation is more investment into machine learning transaction monitoring. We've always had transaction monitoring. You need it to become direct members of Faster Payments and all the good stuff that we've done. But that was in-house built, and we're in keeping with what I mentioned earlier, using best in class, and that is bleckwen.ai if you want to Google it and have a look at what they do. But it's important to have that hand in hand with more automation. And ultimately, boxes are the key building blocks to everything that we're doing here. And we're very proud of it. If we could turn over the slide, we're now going to move to Richard to take you through the numbers for the first half.
Ian, thank you very much. And I'm delighted to be able to take investors through such a positive set of results, given the background of COVID emerging, from late 2019. So before we get onto the slides, excuse me, just a few themes that I think come all the way through these. The first is that, unlike a lot of fintech companies, we are operationally cash generative, and that just opens so many more doors for us. And I'll come on to that in a moment. The second is, as Ian has mentioned already, our revenue is fast growing. The third is, within that revenue growth, is that the B2B is massively accelerating, and that really goes to the heart of our repivot last year. The fourth, which is a sort of repeat of what Ian said about regulation and controls, we're right on the money with all of those, or we believe we are. And to give you a specific example, we run an out of the money report for those customers who do forward business with us, and who we choose not to take a margin from. We got the report this morning for yesterday at 11:21, so just 7 minutes ago, and we had 47 credit lines utilized, and our net exposure in a forward position is £37,000. The fifth point is that we maintain our optionality on the B2C business. It's not as though we have put our foot on the accelerator on it, but we've certainly taken our foot off the brake, which was necessary to do, and make sure we put development and other resources back onto B2B, which has so successfully led to the new revenue streams. And there's a particular slide that Ian's going to talk to later, which is a really, really exciting slide. So at that point, are you able to move the slides on, please? So we just have a few slides here, and they should be read in conjunction with the RNS, really. And what I've chosen to do in this slide deck is to look at 5 separate half-year reporting periods. And the purpose of that is to really go back to the pre-adjusted, pre-COVID set of numbers. So you can see, some emerging trends, but also some optionality there. And one of the lines to immediately pick up on here is the growth in turnover, the significant move up in B2B, more optionality on the B2C revenue. You can see what it was in 2019. Our contribution margin, and for those who are not familiar with this term, contribution is gross profits less our below the line marketing spend. And there's quite an interaction between the two, because within gross profits, there are affiliate commissions, which is particularly relevant in international payments, but also cuts across into other areas of our business. And, our very talented marketing team will look at sort of weaving around to see what is best served by the affiliate channel, or what is going to be productive if we advertise below the line. Anyway, delighted to report an adjusted EBITDA of just under 1.6 million. This will become much more obvious when we come to the cash flow slide, because in the earlier periods, the adjusted EBITDA was, one could say, somewhat flattered by the capitalized software, and we'll come on to that in a second. But in the meantime, if you don't mind turning the slide, please. So this is another snapshot of the gross profit and contribution by our business segments. And again, I want to sort of point out the optionality of the travel cash, which is the fifth line down, and just look at what it was in June 19 compared to June 21, and what can we do there. Also, over the same period, you see that there's been a significant rise in international payments, and we're delighted to see the spend platform really bounce back as our corporate clients re-engage and are doing very well in the economy. Bottom line here is that contribution over the last 2 years has gone up by £2 million, and most of that has dropped to the bottom line. So at that moment, may we move to the next slide, please? So we choose to do pretty transparent reporting, we think, and I don't apologize for there being lots of numbers. This overhead slide shows the gross costs that we're incurring, not what ends up in the P&L, but how much money we're really spending on staff. Some gets capitalized, but this number here is the gross cost, how much I have to write out from my checkbook to pay everybody. And you'll see how much we've driven down that number, the top line, the staff, and there is no element of subsidy in these numbers from the government on their furlough scheme. This is the gross cost. You will also see, right at the bottom, how much lower it is in June 21 to December 20, almost £2 million lower. We do have some headwinds. We have some headwinds in some technical elements of staff. We have some headwinds with IT, and we continue to ensure that we are guided properly by our professional advisors in the light of the numerous regulatory bodies that we have to report under. But the bottom line is the staff, and how much the staff move by. It won't go down any further than that. We are investing, we are bringing on more front office staff, but it's all way outrun by the increase in revenue. May we move to the next slide, please? So cash flow. So I'm going to try and draw your attention to a couple of the columns on the right hand side of the page first, which is at relatively similar levels of adjusted EBITDA to what we have now. You can see how much we capitalized, and that goes on the balance sheet. The amortization of that is actually higher now than our spend. We said to the market, we guided the market that our capitalized software this year would be in the region of £3 million. It's likely to be south of 3, which is a very significant drop from where it was in the real build period in 2019 and the tailing off in 2020. There are some exceptional items in the half. We said goodbye to 3 senior members of staff who we thank very much for their work with us, but it was natural that they would move on, and we've appropriately settled them out. And that leads us all to this great turnaround of our net operational cash flow from minus 2.7 million 2 years ago to plus 800,000 now, 3.5 million delta. So we're very proud of that and the cost control that sits beneath it. And so if we then go to the next slide, please, which is some elements of our balance sheet. And I would ask you to read this in conjunction with the RNS, not just my comments on the balance sheet there, but the the back end of the statement. So at the 30th of June, we had 10.1 million in cash. That moved to 12.3 on the 10th of September. And the 10th of September figure includes what we had accrued for at the 31st of December, namely 1.4 million of R&D credits owed or anticipated to be owed to us by the government and now collected. We've done quite well with this over the last couple of years. The finance team has done a fantastic job at looking at every element that we could claim. But going forward, we're unlikely to get more than about 600,000 a year. And that's a combination of us moving into some sort of profitability and also the planned decline in development expenditure. What else sits on the balance sheet that's really important for us and how we look at it? Well, the next two lines aggregate to 4 million, and those are balances held with liquidity providers. These are our counterparties for our foreign exchange trading, and they move around, but they certainly include Barclays Bank, Citibank, and some lesser known but equally regulated institutions as well. We also have money tied up with our card provider, and that money again it's regulated, and we almost have to pre-fund what we anticipate our customers spending, and it's a timing difference. It's typically maybe 1 or 2 days. We do have some credits. We owe some money to the people we bought businesses from. That's repayable over the next 24 months. It's all planned. And then we took advantage in December last year of drawing down 2 million from the government on the C-bills loan. It's for the first year, it's interest free. Subsequently, it's slightly north of 2%, but it's not repayable until 2026 and can be repaid without penalty at any time. So if we may next, we'll move to the next slide, please, which I think talks about liquidity position. And this is how we monitor pretty much daily what's going on in the business and maximizing our ability to free up cash for investment and hiring and marketing plans. So we look at our cash at bank, we look at the other balances that we have with either those liquidity providers or card providers, and then we deduct from that the customer margins, and that moves around very, very significantly pretty much every day according to what forward contracts mature for our customers. And the forward contract business is one we like. We're very good at it. We give service to our customers on it. It gives them much more certainty, and we are certainly securing much more forward business. And in the RNS, there's a separate section about the split of the business between the spot and forwards and international payments. I urge you to have a look at that. Now, at that point, maybe we can turn the page again, and then I will pass you back to Ian to talk about current trading and our outlook.
Thank you, Richard. Yes, this comes on to my favourite slide. Richard's favourite slide is the cash one. I think that's highly appropriate. If you could turn again, the next slide, please. Here, the top half is H1 as per RNS and the analysis you've just seen, and the bottom half is the 51 working days up to the 10th of September. So let's just deal with the top half first, should all be familiar. What we've tried to do here is extract what we will describe as the core business lines or the product-driven revenues, i.e. international payments, banking, corporate expenses, and then the cash and retail card businesses, and then other. And X out of that, anything we've made from the solutions platform that I described earlier. You can see the result there. We do like the concept, which I think is good for investors to talk about this sort of revenue per day metric. It's a sort of tangible number that you can relate to. You can see it went up from £110,000 per working day last year to 136 in the first half, and 16.6 of revenue from core and 300k from the solutions P&L. Flip forward to the 51 days up to a week ago, and you can see a massive acceleration here. Let's put some of these numbers into context. Our previous record quarter in total was 8.6 million, which we did last quarter, of which 300k was solutions, as we know. So actually the core business's record quarter was 8.3. You can see from these numbers that as per last Friday, we were already at 8. So the business, the underlying business, if you want to call it that, doing very well and continuing to grow at the same sort of pace that we saw in the first half. Clearly would have a record quarter without solutions. Bulk Solutions P&L on top of it, and we get a very encouraging picture. 9.2 million for the quarter to date, as of last Friday, with still a significant number of working days to go. In terms of revenue per day, that's 180k per day compared to 114 this time last year for the same period, 136 in the first half. Very, very steep growth, 58% up this period compared to the same period last year. I think that tells us all on this call everything we need to know in terms of the trajectory the business is now on. If you could turn the page, please. So what do we focus on the next 6 months? Just by the way of telling you when we're likely to speak to shareholders, excluding anything new and exciting that we may announce, we will probably give a sort of trading indication in early December of how the year has gone up to then, to give people some idea of the flight path towards the end of the year, and then we'll do a trading statement in January, normally quite as early as we can in January. Historically, we've done our full year numbers in April. We could do them earlier, and we'll try and do them earlier, but it's actually dependent on getting the auditors to give us a slot and all of that planning, which is not the easiest thing in the world to do, but we will endeavor to do them as early as we can. We're definitely in a good place to get that done. So next 6 months, revenue growth clearly has to be a key priority. Well, the own name iBank capability is key to that. Driving platform-based revenues, as I mentioned earlier. CRM, more effort to be put there, more investment in terms of the sales enablement team, which actually leads me to that growth team that I mentioned here. We have a recently incorporated growth team, which includes sales enablement and marketing, and it's focusing on the entire customer experience and the entire customer interface with the company, which will almost be like a sort of a SAS running around the company to push growth where we can see opportunity. We've revised the sales structure, simplified it. Richard mentioned some high-level departures. We've leaned down the exec, promoting from within, and we've got better KPIs there. We're also increasing our use of affiliates. If you can't get the customer directly, then get someone else to get the customer for you and pay them via a commission is a good way to do it. We're data informed, not data led. Interpret the numbers. Data, particularly when it comes to customers, can only tell you about the customers you've got, not about the customers you don't have. So you have to view it in context. Investment, we will continue to invest. As Richard said, in terms of capitalization of internally generated software, that's at a lower level, but there's a healthy heartbeat there. We still have a decent sized engineering team and will continue to do so. And we've got lots of stuff we want to do. Further implementation of boxes, as I described earlier, and the whole straight-through processing agenda, hand in hand with the machine learning transaction monitoring. Our card products are all currently prepaid cards. We'll be moving them all to self-issue. We'll be the issuer, and they'll all be debit. There's some quite sophisticated things we can do once we do that. We can replicate how a prepaid card operates on the debit platform, but also offer the debit functionality, which is just way more powerful and provides more options for the customer. Equals Money and Equals Solutions, we'll be adding more functionality and more connectivity, more direct plumbing, which just drives efficiency. Which moves me onto costs and efficiency. We're going to carry on with our focus on costs. It's got us to where we are as part of it, but not at the expense of growth. We can, as Richard said, now look forwards rather than over our shoulders. We can look forwards and invest where we think it's appropriate. I do want to upgrade further our sales capabilities. I know that we have an opportunity now with the product suite we've assembled and the platforms that we've assembled to go at this quite hard. And we need to carry on with that process. We will look for additional efficiency gains. At the pace of growth we're currently under, you could run out of capacity quite quickly if you don't look forwards and make sure you reinvest in capacity. And a lot of that efficiency gains will be used to drive more capacity rather than necessarily get rid of staff numbers. I see our staff numbers, as Richard mentioned, drifting up somewhat, but we are at a phase now, and I think it's clear to see, of operational gearing. If we doubled in size, clearly our costs would be nowhere near doubling, and we're at a good fighting weight, but we'll add heads where we need. Hand in hand with that is using outsourcing, be it using other platforms, be it even in engineering, rather than have every engineer internally employed. We'll use offshore where applicable. We've done some in India with mixed results. India, the cost per person there is way cheaper, but some of the technical capabilities were not quite where we needed them to be. We're having more success with nearshoring in Poland. We've actually, my CTO and CPO are in Warsaw today. And so we're going to increase that as we move forward. I think the healthy balance is to have key engineering staff internal and have nearshore outsourcing to sort of do some of the heavy lifting in terms of technical development under their guidance. We can flip the slide, please. So in summary and conclusion, H1, strong performance, B2B led, increasing and accelerating in Q3 as we've seen. Cost reductions, cost culture is embedded, but without compromise to growth potential. We're in a good position cash-wise, cash generative, opens up more options for us. The product roadmap, that's stretches out a year, what we're intending to build and when and in what order and who's doing what. With a leaner, fitter exec that we do now have, we can and we do amend that roadmap frequently. We see an opportunity to make considerable money, let's say in the solutions line, and it was by putting in functionality we'd planned to do in 3 months' time, we'll do it now. So we can move that around. That's what you want in a company this size. Part of the advantages we have is that we can be nimble, but you must be nimble to extract that. Equal solutions, as I mentioned, it's a new revenue stream, platform driven, significant growth potential there. People, there's no doubt, you see it in the papers with record vacancies and employment levels, whatever you want to blame it on. The labour market is tight, particularly in fintech and engineering in particular. There's all sorts of crazy numbers being paid, and we had a developer who was okay, who left for literally double the money. So we have to fight that. So we look at remuneration, obviously. We're looking at retention in terms of more sort of share-based retention tools, and the softer side of the people agenda, with the whole diversity, inclusivity, equality agenda, and other levers that we can pull to tie people into the company. It's a clear focus for us. The revenue per day by quarter, you can see there the evolution. I think that trend is clear and encouraging. At the same time, we will extract more efficiency gains, more capacity for growth over the next 6 months and going forwards. So that puts the business on a very, very good footing going forwards. That concludes the presentation. So we will now be moving over to answer questions that have been submitted. Apologies if we don't answer all the questions. We have a certain amount of time constraint, as you might expect. It's been quite a crazy week since we announced. I'll attempt to answer as many as I can. Sorry, Richard and I will attempt to answer as many as I can. And some, maybe repetitions of previous questions. So apologies if every question is not answered.
Ian, Richard, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the top right-hand corner of your screen. But just while the company take a few moments to review those investor questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. We received 2 pre-submitted questions from investors, and I want to start off the Q&A with these. The first one reads, with all efforts made on restructuring the business over the last couple of years, what is management's view towards a potential bidder coming along to buy this business? And the second part of the question reads as follows. What market cap would management put on the fair value compared to current market cap? Obviously, current shareholder institutional support by Crystal Amber would suggest a much higher market cap.
Yeah, I mean, that's quite an amusing question. Clearly, if someone made an approach to buy the business, we'd have to take it seriously, and that would require board approval and shareholder approval, and one hesitates to put a number on that, and that's the process through which we would go. You know, as we sit here now, we're quite more than happy to carry on growing the business as we're doing, and if those sorts of approaches happen, then great. Equally, we don't need them to happen. So there's a clear process for anything like that may occur. I think that's pretty much all I can say, unless you've got anything to add, Richard.
No, not at all. We think the company is significantly undervalued, and we're going to continue to build it and press the flesh, meet investors, talk the story, deliver it through the results, and you know, this is stage one.
Thank you very much. The next question reads as follows. Please could you explain or expand a little bit more on the overseas acquisition opportunities which you refer to in the statement?
I think, to be pedantic, or that we didn't refer to overseas acquisitions opportunities. We referred to the possibility of overseas expansion, and concurrently in the same sentence or paragraph, we referred to that we would be open to make acquisitions. So overseas, clearly, with everything that's going on Brexit-wise, it would be good to have more of a foothold in an operational company in the Eurozone, just you know, depending on how things all shake out, particularly in financial services, which seems to be a bit of a bargaining chip. And there's opportunities for what we do across continental Europe. We already have the ability to do more in the US, as shareholders will know from previous RNSs. We have soft pedaled that over the last 2 years, ever since COVID hit, and so we could and will probably next year we'll have our card platform live in the early part of next year in the US, so we can push forwards there. So we're open to overseas expansion. I think we're at a stage now where we can look to do it. On acquisitions, I think the point is there, over the last year and a half, when we were very much in cash preservation mode, most transactions we've done in the past involved some upfront cash. And so we were quite clear that we weren't looking to do any deals that involve that. We now have more flexibility to do stuff like that. So that's, as much as anything, letting potential sellers of businesses know that we're open for that level of business, and we'll see where that falls.
Thank you for giving a bit more clarity there and answering those pre-submitted questions. Investors have also submitted a number of questions during the presentation today, and I wondered if I could hand back to you to respond to those where it is appropriate to do so. Could I please ask you to read out the question and then say who it is from?
Yes, I will do that. So I have a question, actually 2 from Mark W, but I'll do the first one first. How is your unified product suite, O-Name IBAN, different to Revolut, that seems to be offering something similar? I mean, Revolut have invested a lot in capabilities that are similar to ours. So you're right, it is similar. However, Revolut is very much geared towards self-serve only. You know, you don't have human interaction. Whether they choose to sort of say that they are looking at businesses, it's not their core focus. Their investors are looking for X million B2C users, they see a B2B element as being something where they can actually make some money rather than giving it away. But it's not really their core focus, not what they're known for. So could they do what Equals Money does? Yes, or some of it. Equal Solutions hard enough to crack, because as I tried to clarify, it's not just the O-name IBAN and the products, it's the authorization protocols and the ability to support multi-accounts or multi-entities within one account that differentiate it. And another question also from Mark W. Are there some determining factors that are temporarily boosting transaction levels, meaning current trends are not sustainable? That's a fair question. I think the short answer is no. If anything, you would expect in Q3, when you have a B2B focus, that, actually almost particularly this year, when all of a sudden people could get away in August in the UK, you'd expect the business activity to drop. And that hasn't happened. We take the corporate spend platform as a bellwether. Then July was a record month on that platform. August slightly down, but still strong. In September, we've had a record week, and it's moving along very briskly. So, no, I think the honest answer to that is no, nothing abnormal. Then, sorry, I have to scroll here, so apologies. I have a question from Seneca P. How large is the sales team currently, and what's the geographical reach focus? Sales team, not big enough, going to get bigger. If you add in all the disciplines, and you can kind of make a decent argument that the dealers are also sales, because a lot of them are what we call 360 and do sales, then we're at about 45, 50 salespeople, but I will be increasing it further. And the geographical reach and focus is, if anything, very much myopic UK. We can take inbound inquiries from anywhere in the world, but we are fishing in the UK pond, and we need to expand that more as we go forwards. The next question comes from Richard W. Am I right to say that Equals Group looks significantly operational geared? What factors will further turbocharge future growth apart from the return of travel? Actually, return of travel, whilst nice, it's not the absolute be all and end all now for the business. Someone asked me, if things got back to normal, what would that mean? And that, the order of magnitude of an additional 2 or maybe 3 million of revenue, I think is the answer to that question. So we'd prefer it came back, but I think we could make bigger strides by growing the Equal Solutions revenue line as fast as we can. So turbocharge future growth will be Equal Solutions and Equals Money. And if we get return of travel on over and above that, fantastic. And I think that's like almost a free option for shareholders and investors on that point. Then we have Simon W. What is the company's intention vis-a-vis dividends? Richard, do you want to tackle that one?
Yes, I'll deal with that one. It has an answer in 2 parts. The first bit would be that currently the company doesn't have distributable reserves in which to pay a dividend. It could get there. It would have to go to the court and do a restructuring, and that would cost the best part of £200,000. The second point is, I think that most investors would expect us to consider ploughing money back into growth to increase shareholder value. And if there comes a point where shareholder value is increased less by growing and more by paying dividends, then that's a very key inflection point. But I don't see that, at least within the next 24 months.
Yeah, I would hope that shareholders in general would rather see us reinvesting currently cash into growth. And clearly, we'd like to return the value to investors via dividend at the right time and as soon as we can. But for now, it's not core. And by the way, there was another question from a Harry W on exactly the same topic. So hopefully, Harry, that answers your question. And I have a question from Ben G. There have been many reports of an increase in online fraud during the pandemic. Have you seen any evidence of this? I mean, fraud is and I remember way back in 2012, when we really just had the travel card business, and we almost got criticized by the banks because we were sort of overzealous about turning business away on fraud. Fraud is a difficult topic. I mean, if you think about it, the company can be attacked in three main ways: either fraud perpetrated on us, fraud perpetrated on our customers, and fraud where could be a customer of ours happens to be the fraudster. And we treat all three of those cases with the same exactly the same vigor, because at the end of the day, an instance of fraud, someone somewhere is losing some money, and none of us want that to happen. So it is a fact of life, I'm afraid. We try to get, obviously we would like fraud to be zero. It's practically impossible to do, but you have to strive for that. It has to be your objective. And that is our objective, and we seek to get there where we can. We do work extremely closely with our partner banks. They may see patterns or trends or highlight a fraudster, and we may do the same back to them. As soon as that happens, we see any instance of it, then accounts are automatically blocked, so that any fraud stops, and we communicate with relevant law enforcement and regulatory bodies as soon as that occurs. To put this into context, in the first half of the year, we had 3 instances of fraud, and relatively minor in terms of quantum, which I think compared to the volume of activity that we do, as you all know, you can see is a very low level. Also, we've done extensive research about where we sit compared to our peers, and our fraud levels are literally 3 times better, i.e. lower, than the industry average. That doesn't mean to say we wouldn't rather it was zero. Of course we would, and we'll continue to strive to do so. But I think we're investing way more in anti-fraud measures than literally any of our competitors. Next question. This is another interesting one. Maybe Richard, you can tackle this one. Jason N, thank you for your reply to my question. When you say the company is currently undervalued with a market cap 120 million, what percentage would you say you are undervalued to your peers?
1,000%.
It's so difficult. It partly, your valuation can be restricted or not, depending on who. I don't want to insult investors, but like if you're backed by PE and they follow their money at crazy valuations, then that's your valuation, if you see what I mean. And we've seen instances of a taxi company floating with a investment prospectus saying that it'll never make a profit, but being worth billions of dollars. Equally, there are listed businesses not too dissimilar to ours that are trading on 12 times revenue, and that puts a different complexion on us. If we were on even 6 times revenue, we'd be probably double the valuation we are now. I think what we've seen in the last week, and hopefully continues, is that the investor base, institutional investor base, and retail are acknowledging that there's a revenue stream that's growing here. There's a platform based as well as product based. Over time, that'll take care of itself. We do feel that our market cap ought to be higher than it is now, but obviously it's a lot better than it was 6 months ago. So all we can do is carry on producing as we are, I feel, and communicating clearly with the market and the investor community, such that they understand exactly what it is we're doing and give frequent updates. So hopefully then everything will take care of itself.
If I may add, Ian, that the really seismic change over the last 12 months has been to move into operational cash generative position, which means that we can go out and hire now. And this interim statement has been a very, very important step in being able to portray ourselves in a much more positive light, not just for investors, but also for quality candidates. So we can continue to grow, continue to build the revenue, widen the product set, and just increase the talent pool that will increase the value of the company going forward. We've got a very, very energetic, fired up team, and we look forward to that continuing.
Indeed. Another question from Mantis P. I quite like this question. You mentioned big things are coming on Twitter. Any chance to get some more details? The Twitter feeds and social, and what you're seeing there is more a marketing, the marketing effort to win B2B business. So that's more equals money, equals solutions. That's the big things that are coming there in terms of functionality that a B2B potential client may be using, rather than some exciting numbers, although I expect the two to go hand in hand. We are excited where we are. It's been a tough couple of years. I make no apology for saying that. We've pivoted the business from B2C to B2B in the glare of being listed on AIM. It's not the easiest thing to do, but you've got to carry on producing in the meantime. And I think the market can see now that that investment was worth it, and things are starting to pay off. We have a question now from Tim W. Has Brexit benefited the business, or has it created issues with UK companies doing business in Europe? I think more the latter, to be honest with you, Tim. We had instances where companies have said, well, we can't get a container, we can't do this, we can't do that. It was more acute. It's becoming less acute. People adapt, businesses adapt. So we're seeing that, but it's not been, we could have done without it. But I think now that headwind's sort of abating. And I think that's it, because the last two things I got on there are thank you for your answers, which is nice. Thank you for thanking us.
Ian, Richard, thank you very much. You've been very generous with your time. I think you actually managed to answer all the questions from investors today. And of course, the company will review any further questions submitted and publish responses where it's appropriate to do so. Ian, just before redirecting investors for feedback, I wondered if maybe you could give a few closing comments.
Yeah, I'd be delighted to. Firstly, I'd like to thank everyone for their time, listening to Richard and myself. Hopefully we've presented where the business is, where it's going, and answered your questions. Personally, speaking for myself and everyone that works here, we're extremely excited with where the business now currently sits. We've got a motivated workforce here that's looking forward, and everything that we're doing, the functionality we already have and what's coming in the next 6, 9, 12 months, and the opportunities for the company are really, really exciting. It's so much more enjoyable working in a business that's in that position than, let's say March last year when we were all entering into the COVID nightmare, and steps into the unknown. I'd like to thank any shareholders on the call for their support. I know it's been a bumpy ride, but hopefully we can now all see the direction of travel of the business. And thank you for your time, and hope to communicate with you again soon. Thank you.
Ian, Richard, thanks again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, however, it is of great value to the company. On behalf of the management team of Equals Group PLC, we'd like to thank you for attending today's presentation. That now concludes today's session, and good afternoon to you all.